there's an element of opportunism. There's an element of people getting even richer than they were and that getting to their head. So there's kind of an asset or unrealized capital gain folly that takes over them. So that would explain why they shifted and why you have this sort of new aggregate of capitalists now joining the Republican Party under Trump. But looking at your work, this seems to be like the culmination of a long trend, which can be seen as the crisis of the publicly traded corporation, in a way, and this ascendancy of patrimonial capitalism. So the question then is, what does the makeup of Trump's entourage tells us about that recent transformation of or within US capitalism?
Yeah, so it's important to note that you can go back as far as the 80s, before in fact, and you'll see that these closely held private companies, often these dynastic businesses, are very active on the extreme fringes of the Republican Party. So you already have the Coors beer dynasty. You have the Koch brothers, of course. You have the DeVos family. And they're very active on the not quite, I mean, they're certainly not the mainstream of the Republican Party, but they're very active on the ideological edges in their kind of fringe subcultures. So in the Council for National Policy, the Cato Institute, they're actually creating a lot of these networks and institutions. So I think, I mean, there is a recognition that this kind of form of capitalism in American history, particularly in the later part of the 20th century, tends to be ideologically quite hard right, you know, and has very much a sense of its difference from the corporate mainstream that agglomerated around the New Deal state. Okay, so I think Eisenhower has, in some letter, wrote that there's this crazy fringe of Texan oil billionaires, the Koch brothers, I think he was referring to the Koch brothers' father, who think that the New Deal state is socialism on wheels, and they're really quite fringe. They're of absolutely no significance, but they're really quite weird and very zealous. So, you know, 40, 50 years later, they're still quite weird, still very zealous, but not fringe anymore. They still were somewhat fringe in the 1980s. They're doing a lot of institutional building, creating a lot of networks. And there are these kind of channels of communication between the Republican mainstream and these far-right networks. And you have figures that are always trying to enter and push things to the right. The Gingrich gang and, you know, Gingrich and friends. They never quite manage to do that. And it has to do with two things. Firstly, the corporate business form remains hegemonic, okay? And secondly, the money they have is, there are all kinds of firewalls that stop that money entering the political process and infecting the mainstream of the Republican Party with their virus. And these two barriers just disappear at some point in the last 10, 15 years or so. So I think this is how things have shifted. In terms of the centrality of the publicly traded, widely mass shareholder-owned corporation in American capitalism, the heyday of that corporate form was the Fordist golden years, because the state has arranged a kind of alliance with this form of capitalism and with the unions that become, you know, more or less managers of class consensus to assure a certain continuity to American GDP figures, to assure a certain kind of labor peace. And this business form really does remain dominant right up to the 1980s. In fact, I would say it's at the leading edge of the backlash against Fordism in the 1970s. So you still have these corporate trade associations, the Business Council, which then becomes the Business Roundtable, which are really leading the charge against the overregulation of capital, the excesses of the Ford estate, if you like. So they still retain their power. But in a sense, the backlash that they've instigated ends up destroying them. Because the backlash against the Ford estate and overregulation turns into a backlash against the Ford estate's primary business form, which is the publicly traded, mass shareholder-owned corporation. And this happens in two stages. Okay, so the first stage is the 1980s, where you see this wave of leveraged buyouts or hostile takeovers of the big blue chip American corporations. So we call them leveraged buyout forms, but the later term, the more sanitized term, becomes private equity. These are the early private equity players. And they come along and they complete what looks like a long waning of the corporation in the 1970s at the hands of labor and international competition. But these private investment firms come along and essentially cannibalize these corporate giants. They look at them and say, we can treat these as investments like any other investment. And so what they do is that they take these firms private, they dismantle them from the inside, get rid of the peripherals, with the hope of bringing these firms back to market, reselling the shares that they now own at an elevated price. So the whole purpose of this enterprise is simply to make capital gains on the shares that they have taken private. Okay, you might think, what an absurd thing to do. Surely the corporation is about producing greeting cards or cars or whatever were the big corporations that were taken down by the corporate raiders at the time. But these private investment funds have existed for a long time. They've always been about making capital gains. When they went into oil prospecting, it was simply to make money out of selling the right to the oil wells. They weren't interested in the oil itself. When they go into real estate, it's about making money on the increase in land values. They don't care if the property is run down or livable. It's really not what they're making their money out of. So for these private investment firms, these corporations were just an obvious target for their investment strategies, and they managed to make quite a lot of money out of it. And you get a first kind of wave of new family dynasties that arrive at this point. If you look at some of the corporate raiders at the time, either they already had family wealth, or they were people like William Simon, the Treasury Secretary, who becomes a multimillionaire and then billionaire. And now his children have this giant family office. So this happens. The significance for the corporation is that it doesn't disappear, but it becomes something very different. And it's almost as if the corporation has introjected the spirit of the private investment fund into its kind of internal, this is getting a bit psychoanalytic. It didn't introject, it internalized the private investment fund so that now the whole rationale of the corporation, its management priorities, its forms of discipline are about creating capital gains on share value. So what does shareholder value mean? What does it mean to increase shareholder value? It simply means to increase the price of the share as a financial asset to allow the shareholder to make capital gains on that asset. You can also convert that into income form because assets can generate capital gains and income. In the case of shares, you're wanting to increase dividends to the shareholders, so you can do that too. But this becomes the whole point of the corporation. Now, what private equity has done here is completely and utterly transform the profit form of the corporation. to get a sense of how this has shifted, think back to the classic Fordist corporation. To make a profit here, you need to make a certain profit on the sale of mass commodity production. And once you have made that profit, you reinvest it back into fixed capital and into the production process. So factors of production, not just fixed capital, but also labor, because you need to create productivity gains that will allow you to make gradually more and more surplus. This is a very different profit form to capital gains, because in a sense, the whole process, the whole cycle of producing commodities, it may still be there, but it's the least of your concerns. You may just simply outsource it to another country, because what you're interested in is the share price. Now, share prices during the Fordist era were much more closely correlated to the industrial profits that a corporation was making than became the case after the 1980s, when there's actually an argument in agency theory that profits can be high, but shareholder gains very low. And really, you don't care about the profits so much. You care about the price of shares and the dividends that are being returned. So let's forget about making profit through mass production. This is where it makes sense for this new kind of manager to completely destroy whole production units of a company, because that is not what they're interested in. They're not interested in that profit form. And today you see tech companies that for years are not making profits at all. They may be making losses, but they're not interested in that. They're interested in the value of their share prices. Okay? They may be private or they may be public, but they're interested in the capital gains. So that happens there, and this changes also the persona of the manager, because it's usually a he, may look like, the professional manager of the past, but he's really acting like a private investor too, like a general partner. And agency theory has done everything it can to make sure that the incentives that drive him are the same as the general partner in a private investment fund. So that is the whole rationale behind paying people with their stock options, because if your income is directly correlated to the value of the shares, then you don't care about profits, you care about share value. Okay. So that's the first shift, I think. The 1980s is where this happened. But if you think of it, the corporation is still there, and IPOs don't disappear. In fact, the 1990s is the heyday of initial public offerings. So the second big shift is in the 2010s, and so this is where suddenly you have these startup firms that are staying private for very long periods of time. And you're seeing a very dramatic shift in the internal structures of these corporations that endure even after they go public eventually. Okay? And this is where I think you're seeing a real shift to what I call the patrimonial firm. So this is partly accidental and partly fateful. Everything looks fateful right now in retrospect. But, at the time, it might have been hard to anticipate. So that in 2012, I think, the Jobs Act, Obama's Jobs Act, was enacted. And this, ironically, was supposed to kickstart the market in IPOs, because there was a fear that the very harsh regulation of banking credit that had been brought about by the Dodd-Frank Act would starve these corporations, these new companies of funds, and they wouldn't be able to come to market. You'd have a kind of big slowdown of the traditional IPO market. So what they did to enable an alternative source of funding was to relax the rules on the number of limited partners that a venture capital firm or private equity firm could have. Okay. So suddenly they could have a very large number, and this means that they could raise enormous amounts of capital and not only compete with the traditional banks to fund these new firms, but also outcompete them. They became the major funders to new companies, fledgling companies of all kinds, but the major impact was in the big tech sector. And this coincides with This is 2012, so this coincides with this long cycle of Federal Reserve quantitative easing that lasts almost a decade, I think, and which is really all about making credit as cheap as possible and bumping up the price of assets, including stocks. So these two things converge to create this effect where there is just a tsunami of private credit. And these companies find that they have so many offers of credit from not just from venture capital, but now from private equity funds. They're flush with credit, and this means they don't actually even have to go public. They can remain private for years on end, and they can remain private until they reach unheard of valuations. You know, they're valued at billions of dollars, and they're still in the private markets. Normally, to get that kind of capital base, you would have to go public. You would have to sell shares. That was the kind of traditional pathway that a company followed. You have to lose all the privileges of being public, not being so regulated, having a lot more, I guess, autocratic control over your company to get the kind of capital that an IPO allows. And this trade-off no longer functions. Okay, so you have these so-called tech unicorns, and they're all the kind of familiar names of, you know, the Silicon Valley widget world. It's like Dropbox and LinkedIn and what have you, and Uber. And these are companies that have extraordinary asset valuations, but remain private. Now, the significance of this is that by remaining private, they're able to hold on to internal organizational structures that are very different from that of the classic managerial corporation. Okay, so to put it in a nutshell, the founder or the founders retain control of their baby for a very, very long time. It remains in this kind of larval state where, you know, the romanticized startup founder who has to let go of his baby at a certain point, now he can hold on to his firm and retain very tight control over all the company's decisions, and a lot of power over employees, a lot of power over his own compensation package. All of this while the firm just becomes extremely big. And this is unheard of. This is kind of returning to a kind of Gilded Age situation where you have these giant privately held companies. And that was considered something that just could no longer be sustained in the world of big industrial corporations in the 20th century. What's interesting again is that when they do go public, they don't go public because they need more money, but they go public because they want to, their employees maybe want to cash out shares or what have you. But when they do go public, they manage somehow to hang on to these very distinct organizational structures. Okay, so the founder or a group of founders remains in control of this company even when it has gone public. And the way they do this is by reviving these little devices that were traditionally used in family-owned companies, the dual-class share structure. There's other kind of little contractual devices they use, which essentially mean that even when they lose majority control of a company in terms of share ownership, they retain control. Even when they lose majority ownership of the company, they retain absolute control. So they have a kind of minority veto over any decision that the company makes. And you might think, well, you know, who cares? A lot of people were willing to buy into these companies. A lot of shareholders were very enthusiastic, and they didn't really care that they didn't have a shareholder voice, you know, and it's probably very overstated what shareholder democracy means. But I think the really key issue here is that to have this controlling share of the company means that they also have absolute power over how the company's income is distributed internally. And who would have guessed they have this marked preference for distributing upwards in quite extraordinary ways? So there are these people who may be minority owners, but have majority control rights, and who are earning or drawing in these extraordinary compensation packages, and basically creating the situation where they become billionaires very, very quickly. And around that whole situation, there's a whole kind of mythology of the founder, a kind of romance of the founder that becomes quite ubiquitous in these circles. Ubiquitous, popular among the founders at least, maybe not among the Uber drivers. But if you look at, say, the screeds of Peter Thiel and, his far-right friends, Mencius, Mold Beetle or whatever, and Nick Land, Moldbug, they're all fascinated by this idea of the company founder as a kind of atavistic, almost feudal or monarchical character who, because of this autocratic power, is somehow capable of feats of innovation that no kind of anonymous bureaucratic manager of the professional managerial class could quite realize. Okay. This is one of the factions that becomes extremely important to Trump in his second term as president. And there's an interesting and I think significant symmetry between the experience these people have had within their firms, this very kind of megalomaniac experience of becoming billionaires and holding a kind of power that even the corporate CEOs of yore did not have. There's a symmetry between that and the kind of political tendencies or political experiments that Project 2025 is wanting to carry out. So I'm jumping forward to this idea of the unitary executive here, but there's an interesting symmetry between these fantasies of the founder as the kind of creator of a new dynasty, the creator of a new world, and this idea that supreme executive power should be invested in the president and that the Constitution somehow enables this.